When it comes to making money in the market, the most important thing is size. Size matters. Contrary to what you might have heard, size is very important if you want explosive returns. Whenever you're doing swing trading or even position trading, if the size of your positions is very small, you're not going to move your account very fast. So important thing in order to make account move is size. And so let's look at this size in terms of how it impacts your returns. And in order to do that, let me show you my screen and then we go from there. So essentially, whenever you're doing swing trading, what happens is that if you're taking a trade, and in the trade when you're taking, if let's say you're putting 5% of your capital, so you have 100,000 and you're just putting 5,000 at risk, right? Now what is going to happen is, if this is a swing trade and supposing it goes up 20%, your overall account is going to move by 1% only, right? And in that case, you're not really moving the account. Now the same trade, some other trader takes the same trade, but instead of putting in 5% of his capital, if he puts in, say, 25% of his capital at risk, so that will be 25,000. So when you have 25,000 at risk and there is a 20%, you're going to move your account by 5%. Now if there is another trader and he goes really aggressive and puts in 50% of his account on that same trade, right? What you're going to do, what you're going to look at is the account will move 10%. So whenever you hear people making big returns, always check their size. Okay, check their size. Size is extremely important in the market for your explosive returns. And whenever you're trading setups where you have high conviction, and if you have high conviction and if you're not putting in big amount of capital, then you're not going to make big amount of returns. Now there is one way of doing size, and which is like basically increasing your per trade risk. There are other ways to increase size, and those other ways typically involve you going into margins. Now whenever you have margins allow you to do a larger size positions, and as a result of that you can have higher returns. Now if you have a large account, many brokers are going to allow you portfolio margin. Portfolio margin is higher than the normal margin. In US markets, normal margins is typically double your capital. So if you have 100,000, you'll be able to trade 200,000 overnight. But if you have a portfolio margin is typically available for a larger account. Then supposing you have a 1 million account with a portfolio margin, you might be able to trade 5 million. As the margin increases, the leverage increases, and as a result, you can make bigger amount of money. So if you want to increase your returns, you have to think about size. Now, in order to do size, it's very important that you have setups where you have a very high conviction, or you have a methodology, or you have a setup where your stops are not very wide. Because if you are going to take bigger size positions and bigger size risk, and your stops are just like 20%, 25%, then your chances of blowing up are very high. But if your stops are very close, then you can take a bigger size position. And in order to get bigger size positions, or in order to get stops closer, you need to then time the entry very precisely. If you can time an entry very precisely, then you can put a close stops. So think about this. In order to increase size, you need to have higher conviction. You need to have positions which are larger than typically which you take. And the third thing is to find situations where your stop is very close, so you can take larger size. In certain kinds of trades, like episodic pivot, there is a very strong catalyst for that particular move. In this kind of trades, if you are taking very small sizes, then you are sub-optimizing those kind of situations. If you have very high conviction on an idea And if you can put in larger size positions, then what will happen is that you will make more money. So one of the ways of increasing your returns is to increase the size of your swing positions. If you're trading with just 10% of your capital per swings, you can increase it to 25% of your account, then you will find that you can increase your returns very dramatically. So that's one way of increasing your size. The other way of increasing returns is by doing number of trades. If you're doing 100 trades in a year, you're doing less size in terms of number of trades. If you're doing 500 trades, if you're doing 800 trades, you're doing 1000 trades, then your returns increases, because it's again the size principle. Because if you're just making 1 or 2% per trade and you're just making 100 trades, right, you're not going to make money, but you're not going to make dramatic money. But when you increase your size in terms of number of trades, 500 trades, 1000 trades in a year, then what happens is that your returns will increase dramatically. A combination of doing large allocation per trade and doing large number of trades is the explosive formula for making big returns. So if you are looking to make big money in the market, always remember size matters. Grow your size, grow your confidence, and once you grow your confidence and you have more confidence in your setup, go for size. You may not go on every trade with a big size, but whenever there is a high conviction trade, always try and go with bigger size. Bigger size is equal to higher returns. And this is just mathematical truth which is not going to change. So when it comes to stock market, size does matter.